if you had to pick one market with the greatest percent movement, whether down or up, I think it's silver. It would have the greatest percent gain, and probably the gold miners as well, because we know that they're, you look at a long-term spread chart of, let's say, the XAU index, which originated back in the 1980s, and compare it to gold, we're off the page cheap, and it's been laying there. It's not getting cheaper. It's been there since, for the last 8 or 9 years, just laying there dead on the spread chart, holding its own versus gold during that time, where the spread's gone sideways, so it's par performer, but still very, very cheap in relation to gold, and or in relation to the S&P 500 too. That component of stocks, the miners versus S&P, are dirt cheap. Now, you could say, well, they're garbage. Well, or the other possibility is it's a bargain.
Michael Oliver, thank you for coming on the show, my friend.
Good to be here, Danny.
So for people who may not know who you are, Michael, I certainly know who you are, but for those who don't, the one or two out there, can you give us a little bit of an intro on yourself? What got you into investing, gold and silver, all of that stuff?
Oh, geez. Back when I was a kid, practically in the young 20s, I joined E.F. Hutton Commodity Division in New York, Lower Manhattan headquarters. And I didn't know a damn thing about technical analysis. I knew a lot about gold, and I gave up an academic career and got into the future side of the business. Gold had just been legalized in January of '75. I got hired by Hutton in April, and I spent a year and a half up there. I apprenticed under the head of the department, who was also chair of the COMEX at the time. Those are interesting years, the '70s, bunker hunt years and all that stuff. Anyway, so he taught me, normal orthodox technical analysis, price chart stuff, and it was a great experience. And I was a gold bug. Obviously, an intellectual attachment to gold. I'm a libertarian, and gold is money. Okay, I'd rather have a solid money in my hand than something that inflates every day. Okay. Anyway, but in 1992, I left brokerage and started research company called Momentum Structural Analysis. So that's 32 years ago. Because what I developed was a variation of technical analysis. Instead of looking at bar charts of price, I analyzed bar charts of price measured against given moving averages, meaning an oscillator, where I'd oscillate the price versus, moving averages, short-term, long-term, et cetera. And I happened to catch the crash in '87. That's when I was a broker at the time. And that smacked me in the face because I knew why I caught it. It was a technical reason. It was very obvious when you looked at the charts. In fact, I've shown them before in some old reports. But if you saw the momentum charts back then of the S&P 500, and you saw a price chart, you didn't see it coming. You looked at the momentum charts, you said, oh my God, what a floor. You ever break that, you're going, they did. 2 weeks later, they crashed. And so it smacked me in the face that, I need to develop this more. And so I developed the methodology more and more depth, different time dimensions and so forth. And I got hired by, not hired by, but I got a client firm, a major bank at the time, that wanted to pay me soft dollars for the research. And we branched out to retail subscribers in 2015. And we analyze all four major asset categories, and especially this day and age, and I speaking with some history, the integration or the inverse or the correlation between certain markets has never been more important. You can't just, like, if you're a gold bug, you just can't look at gold. Really, it's a stupid thing to do. You need to be looking at what's going on in government debt markets, U.S. stock market in particular.
It's all intertwined.
Yeah, et cetera. Yeah, they bump into each other like icebergs, okay? Now, I happen to have a view, though, that gold tends to lead the events. Most people look at gold just like they do the stock market. Say, oh, a data point today. It means
that's what it did in 2020.
Yeah.
Gold ran first.
It ultimately, it leads and anticipates the unfolding of events that later come. And you look back and say, damn it, knew it, and I think that's why gold has been doing what it's been doing for the last 3 or 4 months, but especially the last couple of years, where it just persisted up at that 2000 plus level. Just, they'd knock it down and it'd come back up again. That's not a top. You go look at history of tops, you don't top that way. That's a launch pad. Anyway.
That was a quadruple top from
Yeah,
2020 up until a few months ago.
Yeah, you go back and look at old highs in gold, and when you made a high, you made a high, period. It was over. You never came back to it. You might have tried to, but you didn't come back. But coming back to it again and again, even price was telling you something, which a lot of people overlooked. Anyway, so gold is now broken out, and I think our argument is the stock market's been topping since early 2022. And even though the S&P and NASDAQ have made single percentage new highs, especially S&P, largely due to very, very limited, heavily weighted some, but it's a very narrow market now. And we know in history that that's not good. But forgetting that, the momentum technicals of the stock market tell us, one, we've had the biggest stock market bubble in U.S. history in terms of the percentage gain since 2009 and the duration of the bull market in terms of years. You go back and look at 1923 to 29, look at the peak in the mid 1970s, look at the peak .com. It was like a 4 or 5 year bull run. That's all. Triple, quadruple, that type of thing.
Yeah, it's unprecedented.
Yeah, it wasn't, they don't compare to the bubble we just created in terms of the dimension. See, S&P has gone up 7, 8-fold since 2009. NASDAQ 100 has gone up 17-fold since 2009. There's no comparison. And you said, well, because the economy's strong. Well, look at an M2 chart. In Fed funds, St. Louis, you look at an M2 chart going back to the 1950s. And it's this upward curving thing. Doesn't matter what decade it is. You almost double the money supply every decade. Now it's even more this past decade. And then look at a Fed funds chart. The Fed funds chart is, they dropped rates very low. I think it was 25-year-old low back in 1994, 95. And what followed was the dot-com bubble. And then after the drop from the 2000 high to the 2002 low, during 2001, oh, here we go. What you got? That's it.
There it is.
Yeah. We've leveled off a bit, but still decade to decade, what's happened in the last 10 years is you can see that sharp run up there. We're more than the normal decadal increase. And it's starting uptick again. And Fed funds have done the same thing, except inverse. They gave us free money between 2008 and a couple of years ago. We had effectively free money, okay, lowest in history. And so naturally it filled the tank, the gas tank. And so naturally you had a biggest bull market in history because you had the freest money in history. And so that money went somewhere. And frankly, at the 2009 bear low in the stock market, we put out a buy signal 1 week before the low in March 2009. And it was technically justified, but boy, did it persist way beyond what we thought it might. And that's because of what they did monetarily. And I think gold knows that because it knows that every time that stock market tops and then turns down, look at 2000 top, for example, or the 2007 top, followed by a bloody bear market in the stock market, gold goes up. And also T-bonds go up, interestingly. Now, lately, the T-bonds have been going down, meaning higher yields, along with the stock market. But they're about to turn, I think. About to have a sharp, probably several quarter rally in the T-bonds.
I see.
And this is exactly what happened in 2007. In September, it was mid-September 2007, the Fed had been raising rates for a couple of years, up through 2006. They paused, and then in 2007, in September, 1 month before the top tick, Bernanke cut rates by 0.5 basis point. And the S&P had this last 4-week, 3 to 4 week rally into mid-October, and that was the top, okay, even though they cut rates. But if you look at what happened to T-bonds and gold then, it was very similar to what T-bonds and gold did in early 2001. They took off upside while the stock market went down. So, archivally, you can look back and say, oh boy, if the Fed would just cut rates, that's great. No, it isn't. Because if you look back at 2001, in the very first day of 2001, not far off the price highs, by the way, that had occurred in August of 2000, dot-com peak I'm talking now. They cut rates, and they cut rates savagely for the next couple of years, and the market crashed savagely. Okay. Same in 2007, they cut rates in September, market peaked in October, started to puke for a couple of years. They cut rates all the way down. So Fed cutting rates is not good for the stock market because it means they're actually panicked about something.
Yeah, it's like going to the doctor and getting prescribed medicine. Well,
yeah, everything's fine, but here, take this right away.
Yeah.
Good point. But anyway, so right now, I think the audience out there with the data points we've had lately, the employment data, Monday and today, some numbers, it's reinforcing the notion they're going to cut, and it probably won't be at the end of the year. It may be sooner, and I think we're waiting now on the ECB to cut possibly. So okay, so there's all this investor anticipation of the good news of a rate cut. All I can say is go back and look at the last two major stock market tops and tell me if that's a good event. Okay. And also look at what gold and T-bonds did then, counter to the stock market. So I think that's where we are. And a lot of these big tectonic plates are moving, positioning, get into position for doing what they're going to do. And the dollar has also been a real quiet non-factor for the last 2 years. If you look at a dollar index chart, it's been in like a 5 to 6% range. And if you go back about 10, 20 years and look at that range, it's one of the narrowest ranges we've had on the dollar index in a long time. Right. It's literally asleep, in other words. It collapsed from a 115 price high. Yeah, on the left there, you see that in 2022. Yeah, that peak. It collapsed, but then you spent almost 2 years just going dead.
Mm-hmm. And
now we've got some numbers. You can't see it on the price chart. The price chart lows are down around 100 there recently. But momentum, quarterly momentum of dollar indexes, we measure is the monthly action in its oscillator relationship to its three-quarter moving average, or a 40-week average would be comparable, for example, in duration. You're measuring price versus a long-term average, and you're oscillating it. You're not just laying the average on a price chart. It is meaningless. When you oscillate it, you have a multiple point uptrend line on the dollar index. It goes back over a year. If you close the week out down near 84, let's say, excuse me, what am I saying? 104. Right now, I think we're 104.30. So actually, our number is about 104.30. But if you close the week out there, we're going to break that structure. And so what we're suggesting is that other tectonic plate, the foreign exchange market, the major foreign exchange market, is about to get noisy again. And it's not been a factor for the last couple of years in terms of any movement of significance. And if it starts to get noisy again, then all of a sudden, all your four major asset categories start to do something which is likely to surprise some people in terms of which way they're going. And I think gold knows that. I think it's known it's coming. It knew there's a bubble going to break. And when the bubble broke in the stock market, it knew the Fed would do what they always do, which is print. And the ECB too, they're all lumped together. So it's a very interesting time.
Yeah, I mean, this comes off the heels as of today. The Bank of Canada, for the first time in 4 years, announced a rate cut down to 4.75%.
Good.
So
Super.
You're starting to see some cracks in the wall.
Yep, that's what it is. And there's another factor out there that I've mentioned for over a year, and now it's starting to be realized by more and more people. We have a political divide in the U.S., right? Okay, everybody knows it. It's unusually wide. It's vehement. It's not friendly. And we've argued that the election, no matter who wins the election, the outcome will be uncopacetic, meaning unstable, meaning it becomes a factor that most people aren't pricing into, for example, the stock market as a variable that could affect things. And I think it's about to hit. In fact, I have a sense that it's going to hit before the election even. We're going to have a sense that, oh boy, you're not going to wait till after the election to see the uncopacetic nature of the events. And that's not priced into the stock market. You rarely see it talked about. in the financial markets. And I think it's going to be an upset factor.
Is gold sniffing it out, do you think?
I think gold knows a lot's coming, and I think that's why it's behaved as it has over the last few years. And now we got all the gold doubters out there, and I'm talking about gold bulls even, who are doubters. And we make an argument that what happened over the last 3.5 years in gold was basically a range-bound situation. We're up, down, up. You sell the rallies, you make some money, okay? And there was one flush out in 2022. But if you chop off a few weeks of that September 2022 puke that dropped down through 1675 and got down to 1613 on gold, that entire peak to low would have been a 20% move. But most of the range of gold during that 3.5 years was 15%.
Mm-hmm.
And everybody thought each drop was like a bear market. We're in a narrow range. 15% is not that big of a deal. And it was holding there for a reason, because I think it knew what ultimately would unfold. And that therefore the central bank would go back to, that which they do best and what they were invented for. Anyway, and now I think we're about there. And now that people realize that, and you're going to have some late chasers of gold. But the problem with the most technicians right now is they're using the analysis that they applied over the last 3.5 years in that range-bound situation to evaluate peaks and lows. What's overbought? Okay, well, there was a certain normality to what was overbought during the last 3 years or so. And when it get there, you could sell it and make $100 or so, And in the case of silver and the miners, while gold went sideways, they staircased downside. They underperformed after a massive outperformance surge that they enjoyed in the summer of 2020, where they beat the pants off gold. But then after that peak, they gave back their performance gains. That too has shifted. If you measure, and we measure it via spread charts, silver versus gold, and GDX, for example, versus gold. We plot like monthly closes. Where's GDX in relation to gold as a percentage? Where's the price of silver as a percent of the price of gold? And we plot that, and we also run momentum studies of it. But they've both broken out, meaning that underperformance trend that we had for 3 years, that trend is technically broken to the upside. Meaning going forward, probably over the next several quarters, the miners in silver will beat gold again. So yeah, watch gold, but
Yeah, so we've got the GDX versus gold. I know this isn't taking into account your oscillation analysis, but for people who are wondering, that's the ratio there. So yeah,
we measure the action since the 2020 just that piece right there from like 2020 high. Right there, right, but go to the right a little bit, right there. That action there, that downtrend, we plotted on a spread chart, and we created a parallel channel, and you've actually broken out, now not a trend line, it's a parallel channel, it's a little more complicated. But we did get out above it. And in the case of silver, it's more obvious. It had like a 5-point downtrend.
Silver by itself?
Silver futures versus, no, not SIL, that's the mining. Yeah, there's silver futures, yeah. Well, just as price has done that, but the spread is broken out as well. So anyway, that to us, that spread relationship shift back to outperformance is what happened also late in the 1979, 1980 bull trend, when all the metals went vertical, and what happened in 2010 to 11 in the last year of that bull market. So in other words, when you entered the acceleration phase of that gold and silver bull market, where silver beat the pants off of gold for the last several quarters of the bull market, I mean, just it rampaged ahead of gold. The spread broke out and told you that I've broken out, I'm now going to get into gear against gold. And not only did their price turn up dramatically in an acceleration mode, as opposed to like an arm wrestling type trend, which had prevailed for years, up, down, but gradual up. The spread also said, yep, that's what's happening. That's what's happened now, actually since late March, especially in April. All these readings broke out. Annual momentum of silver, silver versus gold. GDX annual momentum broke out over a ceiling. The spread versus gold. All these metrics flipped and said the trading range that you lived in from 2020 to 2023 or late 2020, late 2023 is over. Forget those metrics. They only applied to Dullsville market. And frankly, if you get a logarithmic chart of silver, go back 50 years and look at what happened in that last 3 to 4 years, it's one of the dullest, most narrow ranges of ink that you've ever seen in silver, and it's extremely dormant. So to use that time period as a norm, if you put that on a log scale, for example, that clump of ink that you see there in the upper right, sort of like that one there. Yeah, that's back in 1974, 75, you see. But just over to the right, where we're now broken out above the recent range. But that little clump of ink to the left, if you put it on a log scale chart, especially, ratio scale, I don't know if you can do that, but you can hardly, it's like all sideways ink except for the couple months in 2022. Anyway, it's abnormal. It was an abnormally narrow.
Hey guys, quick pause. Have you ever dreamed about seeing any of the cool guests that we get on Capital Cosm or that you see on these other YouTube channels in person? Well, now you can. We can see Rick Rule, Adrian Day, Danielle DiMartino Booth, Dr. Nomi Prinz, Grant Williams, James Rickards, Lobo Tigre, and more. You can do so by joining the Rick Rule Symposium, July 7th through the 11th. You can register now. Link to that is down below. And it takes place in Boca Raton, Florida, on a beach resort. You get to meet all the cool people that you've been watching on YouTube, and you get to do it beachside, on a resort. What more do you want? If you're interested, link to that is down below, and let's get back to the video.
And so any norms that you got from that were abnormally low volatility. And so now we've broken through that stuff. So everybody's saying, oh, silver's overbought. Yes, it is, by those standards. But you can go back in the history of silver and find periods like that where you've had these little tight little clumps, and then suddenly for like 3/4 of a year, it just goes vertical and makes up for what it had not done before. And I think we've entered that phase. And I don't think most analysts are quite yet aware that reality just changed.
Okay, so we've covered gold, we've covered silver. What about another indicator that's pretty pertinent to the health of the economy? Dr. Copper himself. What of copper? You also have ratios like the copper to gold ratio that can tell you whether or not you're entering a recession or not.
It's an interesting thing, and you get to ponder on it. Just look at price, for example. First off, copper broke out by our metrics just above $4 several months back. It surged up over $5, took out the high that we saw in 2022, $5.02. So took that out by a bit, and it pulled back. It's like $4.70 right now. Okay, but there was a high in 2011 when gold was making its high at $1,920 in 2011 peak. Copper was making a high at $4.60. So copper effectively on a price chart has done similar action on a monthly price chart going back 10, 15 years to what gold's done. Made a peak, pulled back, made a peak, pulled back, made a peak, a third new high now. It's not as strong as gold, and I think there's a chance we've got some numbers above copper that we approached but didn't get to. It's in the 530s, for example, and I think we got it in the 5 teens. Okay. Yep, 538, I think, is the number. You get there, you're likely to rush to 7. Okay. But right now it's in an uptrend. They're fighting it around the old highs, which was $5.02 back in 2022, which was not coincident with gold, by the way. Gold had a run up and doubled in summer of 2020. Copper was still in the hole at that point. So copper, though, when you stand back and look at the last 15 or so years, it looks similar, but actually it's not quite in sequence with gold. It's more in sequence with the Bloomberg Commodity Index. But it's looking good. Copper looks good. And we know the reasons. We were told 2 years ago, in fact, by most analysts, the supply side analysts, that there's a supply problem coming with copper in terms of capability to keep up with the needs, And sure enough, it's now exposing itself.
And a demand side problem as well.
Yeah, you don't have to have I don't, by the way, I know the guy who came up with that term, but doctor economy or whatever for copper, I don't think it fits because it doesn't mean to get a strong economy. You could have strong copper, but it doesn't mean a strong economy.
Right.
Sometimes it might,
It's
but I don't
correlated,
think
but it doesn't cause
yeah,
it.
the correlation doesn't fit. It's a fifth because the Bloomberg is resurrecting itself. It doesn't mean you get a strong economy, just like back in the late 1970s, we had strong commodities and a very weak economy and weak stock market.
Mm-hmm.
You know, I think we're at a similar point. But yeah, copper, that's an interesting thought that when you look at copper and gold price and go back to 2011, you say, well, good grief, why isn't silver up there? If silver were doing what copper's doing, it'd be above 50 right now. Okay.
Right.
Well, maybe something's been overlooked here. Maybe that's going to happen. And I strongly think it will, and a lot more. But, on a relative basis, silver is still very undervalued to gold, very undervalued to even copper. And I think it'll do a catch up.
Yeah.
So that's my own personal focus. I can't recommend it to everybody because everybody's different in investment needs and capabilities, but silver's the place I'm focused right now.
Yeah, it's really interesting you bring it up. It seems like there is a bit of a correlation between the copper to gold ratio and the silver ratio, and just silver by itself.
Oh, is there really? Okay.
So that's it. Let me share really quick. It's an interesting thought. So you've got silver here in orange, and then the copper to gold ratio here in the with the candlesticks.
Isn't that interesting? Yeah.
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 So as you can see here, it's a little bit of a gap. So
yeah, but still the basic flow seems to be about pretty good.
Yep.
Yeah. Well, I think that's a valid technical feature there. And I think that the most drama we're going to get out of if you had to pick one market with the greatest percent movement, whether down or up, I think it's silver. It would have the greatest percent gain. And probably the gold miners as well, because we know that they're, you look at a long-term spread chart of, let's say, the XAU index, which, originated back in the 1980s, and compare it to gold, we're off the page cheap. And it's been laying there. It's not getting cheaper. It's been there for the last 8 or 9 years, just laying there dead on the spread chart, holding its own versus gold during that time, where the spread's gone sideways. So it's par performer, but still very, very cheap in relation to gold. And or in relation to the S&P 500 too, that component of stocks, the miners versus S&P are dirt cheap. Now, you could say, well, they're garbage. Well, or the other possibility is it's a bargain. It's like your granddad told you, buy cheap, sell high. Don't chase markets. Okay.
Look for distortions in the markets and capitalize on them.
Yeah. And I think that's where we are. And I think there's been some asset managers. We all know this, Druckenmiller, for example, mid-February came in and bought up a bunch of gold miners and dumped some tech stocks. And, he bought Newmont, for example. Newmont back then was trading in the low 30s. Right now it's in the low 40s. Not bad for, 10 weeks of move, several months of move, excuse me. But I'm sure people chuckled at him when he did that, thought, what an idiot buying this stuff. And others have joined in since, I understand. And I think it's because they perceive it to be, a category of stock assets that just it ain't going to go any lower. Therefore, the risk is very small. And the potential reward is quite good, especially when they look at a gold chart and they say, something's going on here. These miners are underpriced. They're not reality based yet. And if they go to reality, they could go up a lot. And I think that's why you've had some movement. And that's also why I think if you wobble that stock market, and I think we'll do that, I think we'll see it by next quarter, we'll see some sharp decline. When that occurs, portfolio managers, even the non-gold bugs, are going to be looking for segments of stocks that are behaving well. And I think they're going to find in general that commodity-related stocks are behaving well. But the gold miners in particular are dirt cheap and are behaving well, very well on a percentage gain basis. Therefore, let's move 5% out of the stock market, move it over to the miners, that type of thing. And of course, what's important about that is the miners are so small as a category It doesn't, it's the wet bar of soap situation, where everybody's grabbing it and it squirts up. And that's where I think gold miners are right now. So that's another place to look.
Yeah, I mean, you can just throw in gold as well. You look at the total allocation of the gold and gold miners' total market cap as a percentage of total global allocation. It's like less than 1%,
Yeah.
around 1%.
It won't take much. Yeah.
And you track it throughout history. It's like in the 80s, it was 26%. 70s is like 30%, something like that. So doesn't necessarily mean it has to go all the way back up to those levels, but even a small, I mean, going from
even if you
1%
went
to
halfway
100%,
back,
yeah,
halfway back would be enormous.
yeah,
Would be enormous in terms of percentage gain of miners. So, if you're an investor looking for a place to go, you can be balanced if you want. Like we would suggest, being out of the stock market, we did in 2022. So far, you've missed the equivalent of T-bill yields. Okay. If you stuck around, you'd have done as well in T-bills. Okay.
yeah. So what about mining stocks and just commodity equities?
Yeah. In general, if you look at most commodity stocks, they don't correlate well to the stock market in general. So, for example, during a lot of the period of that 2009 through 2022 run in S&P, a lot of the commodity stocks, like from, I think it was 2016 onward, like the XLE, for example, the energy sector, was going down. It wasn't just not going up, it was going down. And a lot of commodity stocks, like fertilizer stocks, agricultural industry stocks, the mining stocks we've been talking about, also base metal miners, things like XME, which is more of the base metal stuff. Right. They've not been really well correlated to the stock market, and they technically look ripe to go up, meaning to reflect a resurgence in commodities. And we happen to think we called a low in the Bloomberg Commodity Index in October of 2020. And it's about 3 months after its low. And at that point, it was coming up from below 60 on the Bloomberg, just above 70. And we put out we said commodity explosion coming. Well, by early 2022, meaning a year and a quarter later, it had doubled, went to 140. Okay. And at that point, we hit some levels of resistance that thought it might pull back. Sure enough, it did. And that's when the war started. People say, oh, it went up because of the war. No, it didn't. It peaked 1 month after the war began in Ukraine and Russia. So you can't blame it on that war. That didn't cause oil to go up or grains to go up. They'd already been going up.
Yeah, I remember. Yep.
Yeah. And now our technicals tell us that the pullback we've seen in commodities since then, and like the Bloomberg, for example, pulled back to 100 level on either side of 100. So it didn't go back to its low at 58, but halfway back from that move in late 2020. And it basically went dead for the last year and a quarter or so. We're just hardly breathing. And then we recently shot up here to 107. I think we're 102 right now. But we broke out on quarterly momentum a couple months ago that said, okay, this basing process that we've seen after the pullback is over. And likely we're commencing the second up leg in the Bloomberg, the first leg being the 2020 to 2022. And we look across the spectrum of the commodities. Energy in general led on a percentage basis that move of late 2020 to 2020, more pronounced among the grains in terms of percentage gain. And copper, of course, is making a new high. Bloomberg, if it were making a new high, it'd be back over 140 right now. So copper, to some extent, is leading this time. But it basically, you could throw a dart at commodities or commodity-related stocks in that 2020 to 2022 move and make good money. And I think the same thing is going to be true this time, where that's a category, a broad category to be looking at as favorably, if you want to be in the stock market.
Has it already formed, or is it in the process of doing so?
I'm sorry, is what?
Are we right now into that second leg of this?
Yes, I think we've started the second leg. And though we did caution when it broke out a couple of months ago on Bloomberg, we said this breakout is an indication that it's shifting its trend back to positive, in sync with its annual momentum trend, which is already positive. The quarterly had corrected and now is joining annual again. But we said it probably won't be explosive. It might be more arm wrestling. And sure enough, it's been arm wrestling. But I think that technically the commodity complex looks like it's ripe for the next up leg. And we did some price analysis as well of the Bloomberg. If you go back to like 2008, and everybody says commodities are high priced. Baloney. We're trading above 100. Okay. Back in 2008, the Bloomberg was 237. Okay.
Yep.
At 2011, when gold peaked, Bloomberg was 170 plus. And right now it's just above 100, and you call that expensive?
I mean,
Okay.
just pop in like the M2 money supply or the S&P in the denominator in a commodity
Yep.
index versus any of those two indices, and it's the charts will tell a story by themselves.
Yeah.
Like,
And it certainly defeats a lot of what we're told from the people above that, oh, commodities are going up because of external events, nothing to do with us printing money.
yeah. So
Anyway, that's an area to be favorable toward, but I don't think it's going to match the monetary metals.
gotcha.
What gold, especially silver, and the miners do. I think on a percent basis, that's going to be the leading category.
Yeah. So this is the Goldman Sachs commodity index relative to the S&P.
Yeah.
And I mean, you can just
Well, it's dirt
clearly
cheap.
see it.
Yeah.
So this
Absolutely.
this was the big move that we saw from 2020
Yeah.
to
That's right.
2022.
Yeah.
150% move, just about.
Yeah.
But
Now that index though is more heavily. We look at Bloomberg commodity
Okay.
index because it's more balanced. This one's got more energy weighting than the Bloomberg.
Gotcha.
So it reflected a bigger move in that late 2020 to 2022 because it was focused more on oil, for example, than it was on other markets. But right now you can, throw some darts and, coffee, orange juice, cocoa, sugar's trying to base, wheat's broken out upside, corn and beans aren't far behind. They've got structures overhead on momentum that say you pop up a little bit further than you've seen recently and you're going to break out as well, in which case the contagion is going to spread within the complex fairly broadly. And if you look at oil too, and natural gas is finally resurrecting itself from the depths of hell. It was free effectively down near $1. What do you want? It's not going to zero. But even the energy complex is not going down anymore. And it's starting to, there's some trigger numbers not far overhead in oil and nat gas that will say, okay, they're gonna wake up a little more suddenly.
So yeah, let's shift gears to energy then. What's your current take on oil? Oil is dropping down quite precipitously. That's $73 right now.
Yeah,
is it just SPR releases or is there something?
Oh, I don't know the fundamentals. I try to stay away from that, frankly, because I don't want to be biased by it. The technicals on oil are such that there is what we call a quarterly momentum trend structure. Now, if you draw a price chart, you won't see this. But you can go back a couple of years on quarterly momentum, and there's like I think it's now a 4-point downtrend line. In other words, if it were a price chart and you had 4 points that lined up and you broke through that line, you'd wake up, right? It's a breakout. Well, quarterly momentum has a pending breakout such that next quarter up in the low 80s, you're going to break out. So now the low 80s doesn't mean much because we had a rally up into the mid 90s a few quarters ago, like the 95, remember? And then we sunk back down into the basing action. Just where we are now. We've been in the 60s, in fact, but now we're in the low 70s. So in the middle of that base, but you pop up one more time and get up in the low 80s by much. And our number will vary. We'll finally calculate at the end of this quarter, but it's somewhere in the low 80s. You get a monthly close up there and oil says, I'm back. And its tonal nature will change. It'll start to resurrect itself more strongly. And that gas has a similar structure, not far above 3. I think it's trading around 270 right now. So there are some trigger levels based on our momentum work that say, okay, this basing action that we've seen, especially in crude oil.
Gotcha. What about coal? I know nat gas and coal tend to be viewed in similar light. You can overlay.
I haven't run coal. I'm
Okay.
sorry. I don't have an opinion.
Gotcha.
It might be interesting to run. Thanks for telling me.
Yeah, I just think it's really interesting that you've got this AI play where you can actually play it buying nat gas companies, buying coal companies, buying uranium companies now.
Yeah. It's
so interesting that our natural resource plays have actually become a play on tech.
AI, yeah, right. That's cool. I love it. No, I wouldn't be an AI right now at all. I mean, what they're telling us about the future based on this new emergent technology It's probably all true, and maybe it's even understated. But remember back at the dot-com top, they were telling us stories about how the internet's going to change your life. And you know what? It changed our lives more than even the craziest bull back then could have imagined.
Right.
It was far more significant than they even said. And yet the NASDAQ 100, when it peaked, dropped 82%, 2002. So it's a matter of, yes, it's real, but on the other hand, it's overpriced and it got way ahead of itself. You need to exhale.
Yeah.
Inhale and exhale. And when you
Very
get a
good
bubble
advice.
that goes like that, when it turns, it often doesn't turn in a way that you can sort of see structure. It just goes straight up and straight down. And I'm talking about, the leading AI stocks right now, which are, of course, heavily influencing what the NASDAQ 100 is doing.
Definitely. Well, hey, Michael, we appreciate your time here on the show. This has been fantastic. Any closing comments before we wrap things up?
Well, I've said this before, especially this year. What's going to happen this year in markets is probably one of the most dynamic years you've seen in many, many decades. And it's only just begun. Gold has begun. I think you're going to see the dynamics similarly in T-bonds, though it won't be a lasting trend there. It may only last several quarters, but a sharp upside. And I think you're going to see it in the stock market, especially our market, which is a bubble. It's not true with, for example, Europe. It's not the same kind of bubble we are, nor China. So focus on the US market as the potential biggest bubble. So the dynamics in these markets could become quite interesting. And I'm not a sports fan, but I'll tell you, you get the best football game you've ever seen shaping up here. So sit back and enjoy it.
Sounds exciting. Well, hey, where can people find you, Michael?
OliverMSA.com, MSA for Momentum Structural Analysis. So you can see about our methodology, some history. Wall Street Journal defines the nature of our work in one sentence. And you can request some sample copies, be fine.
Sounds fantastic. Well, we will link to that down below. And we appreciate your time again. If you enjoyed this content, be sure to give us a like, comment down below. Let me know if you agree or disagree with any of the takes here in this video. Would be happy to respond to any agreements or disagreements. We'll see how it goes. And also, guys, be sure to hit that subscribe button. 85% of you guys who watch this content are not subscribed. So please hit that subscribe button. Support the channel. Let the algorithm boost us. And yeah, we will see you in the next episode. Bye, y'all.